Welcome back to the Deep Dive. Today, we're taking a journey deep into the Earth. We're going to explore this really high-stakes, super technical world of, of energy valuation.
Right.
I mean, we all hear these terms constantly, don't we? Proven reserves, shale resources, P50 estimates.
All the time. But the system behind those numbers, it's basically a whole specialized language.
Exactly. It's a language of geology, of finance, of engineering probability.
And it's arguably the most financially significant language in the global economy. Because these volumes of oil and gas, they're not fixed numbers. They're not certain.
And estimates.
They're highly controlled estimates, and they represent the absolute lifeblood of energy companies. How you communicate their quantity and, more importantly, their certainty that drives trillions of dollars in decisions.
And that's really what we want to get to the bottom of today. That's our mission. We're going to unpack these rigorous, standardized classification schemes that specialists use.
Specifically, the Petroleum Resources Management System, or PRMS.
Yeah, PRMS. The goal here for you, our listener, is to move past those simple headline numbers and really get the critical difference between, say, reserves.
Which is what companies can profitably get out of the ground now.
And resources, which is what they might get sometime later.
And if you follow global energy at all, understanding that distinction is, well, it's non-negotiable.
Okay, so let's hit the baseline. We need some clear definitions right at the top.
Absolutely. So when we talk about oil and gas reserves, what we're defining are discovered quantities. They're from known fields.
Okay, so we found them.
We found them. But that's not enough. They also have to be deemed economically viable and technically recoverable.
And those two things are huge.
They're everything. And critically, these volumes have to be backed up by a real funded development plan, one that's been approved. And you're generally expected to start production within a pretty tight window.
How quick are we talking?
Typically 5 years.
So it's not just there's oil in the ground. It's oil that has a real commercial plan to get to market in the very near future.
Precisely. And that economic part, that viability, makes the whole classification incredibly sensitive to things it has no control over.
Like the global market.
Exactly. If the price of crude oil drops below your calculated cost to get that specific barrel out of the ground.
Lifting costs.
Right, the total development and operating cost. If the price drops below that volume, it instantly stops being a reserve. It has to be reclassified.
Wow. So a deep water project offshore with huge operational costs, its reserves could just vanish in a low-price market.
They could, while a low-cost field in, say, Saudi Arabia remains firmly in the reserve category.
Which means a company's total reserve number is. It's not a static geological fact. It's a living number. It reflects economic reality just as much as it does geology.
It's a snapshot in time. Now contrast that with remaining resource estimates.
Okay.
These are quantities that we know exist, or we're pretty sure they exist, but they're likely subcommercial today.
Meaning you can't make money off them right now.
Not right now. They might still be under appraisal. Maybe they don't have the pipelines. Or they're just too complex to produce profitably at current prices. They're what we call technically recoverable. The physics works, but they're missing that economic certainty.
Or the firm development plan.
Or the firm plan. That's what keeps them out of the reserve category.
And we should probably clarify quickly. We've been saying oil a lot, but this all applies to natural gas too, right?
Oh, absolutely. The exact same classification structure. It's just that with gas, because the volumes are so enormous, they're usually standardized.
Into BOE.
Into BOE, barrels of oil equivalent.
Yeah.
It's just a conversion based on energy content. So yeah, these concepts, they're universal for all hydrocarbons.
Okay, so let's unpack this a bit more. If you have an oil field that's in a stable country, you know there's oil there, why do you need all these complicated probabilistic schemes?
Yeah.
Why can't a company just get a geologist to say, we found 1 billion barrels and just...
And just put it on the balance sheet.
Yeah.
Why not? Well, the complexity is there because the financial stakes are just. They're astronomical. And the amount of geological certainty can vary wildly from one project to the next.
You're talking about the upfront costs.
I'm talking about exploration, drilling appraisal wells, building pipelines, platforms, processing plants. It's what we call front-loaded capital. Billions of dollars before you sell a single barrel.
So these schemes give investors a way to measure the risk on that capital.
A quantitative, standardized, and this is the most important part, a comparable way to assess and underwrite that immense financial risk.
So the classification system is really a universal language for risk management.
That's a perfect way to put it. It allows a banker in New York to compare the risk of, say, a wildcat prospect in the Arctic Circle versus a simple field expansion in Texas.
So what are the key things it's trying to categorize?
Two critical things. First is the uncertainty in the volume estimates. Is your number a conservative floor or is it a really optimistic ceiling?
Okay, the range.
The range. And second, the chance that the accumulation even exists in reality, the geological risk. And that risk changes depending on how mature the project is.
And you only get to call it a reserve.
Yeah.
Which is the really valuable category.
Only after it's gone through that whole maturation cycle. You discover it, you drill it, you flow test it, you prove it's commercial, and then you get the funding authorized for development. Only then.
Which brings us to the foundational rule book for all of this, the PRMS standard.
The Petroleum Resources Management System, PRMS. The last big update was in 2018, and it is, without a doubt, the global standard.
It's not just a suggestion.
Oh, no, it's a rigorous consensus standard.
Okay.
It was developed jointly by all the big global societies, the SVE, WPC, AAPG, all the heavy hitters. PRMS gives everyone the same dictionary to work from.
Well, PRMS is the engineering benchmark. If you're a company and you want to tap into U.S. investors, you have to play by another set of rules.
The SEC connection, yes. This is a crucial distinction.
Securities and Exchange Commission.
Right. The SEC tells public U.S. companies exactly how they must report their proved reserves. And while it borrows a lot from PRMS, its focus is much, much narrower.
How so?
It has a very strong, you could call it a Western capitalistic emphasis. It prioritizes only the reserves that are certain to be extracted, sold, and turned into cash.
So it's all about the money.
It's all about protecting the investor. It often demands proof of existing infrastructure and funding that PRMS might be a little less strict about.
Can you give me an example of how that changes how a company acts?
Sure. Think about a national oil company. Their goal might be to just maximize the country's total resource count, right? For national pride or inventory purposes. They might classify something as in place, even if it costs way more to extract than the market price. The SEC says no, you have to have a demonstrable economic case today.
It forces them to be conservative.
Extremely. The SEC might stop you from booking proven undeveloped reserves PDs if the budget to actually drill them hasn't been formally approved, even if the geology is perfect.
So the SEC is like a regulatory brake on any over-optimism.
Precisely. And the financial impact is enormous. Reserves are the main asset on an energy company's books. The process of adding them to the balance sheet is called booking.
And when you book reserves, your company's value goes up.
Directly. Your asset value increases, your borrowing capacity goes up, your whole valuation changes.
But the other stuff, the non-reserve estimates, like contingent or prospective resources, they don't get booked.
No, they're speculative. Companies might publish them, to get investors excited about the future, to show they have a deep pipeline of projects.
But they're not on the balance sheet.
They can't be. They're forward-looking guidance, not current net worth.
Okay, that focus on rigor and financial accountability, that leads us right into the mathematical heart of this system, the reserve hierarchy. This is where the probability language comes in.
That's right. Reserves are quantified with terms that are all about probability, P90, P50, and P10.
And the structure, it expresses the chance or the confidence level that the actual amount of oil you get out over the field's life will meet or exceed that specific number.
Exactly.
And this is where it gets really interesting because to an outsider, it feels backward.
Yeah.
The higher the number, like P90, the smaller the volume of oil, but the higher your confidence.
Right. A P10 estimate gives you this huge, juicy volume, but with very low confidence, you'll actually get it. It's a range, not one single target.
So you really have to grasp that inverse relationship.
You do. Think of it like this. The P90 estimate is your absolute floor. It's the minimum amount you are virtually certain you're going to recover, even if you get some minor geological surprises.
And the P10.
The P10 is your absolute best case scenario, the maximum you might hit if everything, and I mean everything, goes perfectly.
Okay, let's break down the three main categories then, using that language, starting with the absolute gold standard, proven reserves, the 1P estimate.
Okay, 1P reserves, these are the volumes with the highest confidence. The 1P designation corresponds to P90.
Meaning there's a 90% certainty that what you actually recover will be at least that amount or more.
Correct. And they must be recoverable under today's economic conditions with technology that's already in place. This is the number public companies report to the SEC. It is the most important bankable number.
It's the safe bet, the number you build your budget on. Now, if we move down the confidence ladder, we add in the probable reserves.
Right. Probable reserves are additional volumes that are just a bit less certain. Maybe the geology is a little more complex, or you're planning to drill in a spot that hasn't been tested yet.
Some uncertainty.
Some technical or maybe regulatory uncertainty. When you add proven plus probable, you get the 2P designation.
And 2P corresponds to P50.
Exactly, P50, meaning there's at least a 50% certainty that the actual recovered volumes will meet or exceed that bigger cumulative 2P number.
So 2P is often called the most likely outcome. It's the statistical middle ground.
It's the expectation, yes. And then finally, you have the most speculative category of reserves. The possible reserves.
This is the optimistic upside.
This is the upside. These are volumes with the lowest confidence. Maybe your geological model suggests the trap could be much bigger, or you're hoping to use an experimental recovery method down the road.
A lot of what ifs.
A lot of what ifs. So when you add all three together, proven, probable, and possible, you get the 3P estimate. And that corresponds to the P10 volume.
Only a 10% chance you'll recover that much or more.
A slim chance. But it shows the potential.
So this whole hierarchy, it forces companies to be really conservative and public with their 1P number, while still letting them talk about the potential upside with 2P and 3P to get investors excited.
That's the whole point. But even inside that gold standard 1P category, there's another really vital split that dictates spending.
Developed versus undeveloped?
Exactly. The difference between proven developed, PD, and proven undeveloped, PUD. This is key to understanding a company's cash flow.
So PD reserves.
PD reserves are ready to go. They're produced with existing wells and infrastructure. The oil is basically already online or requires just a tiny bit of operational spending to get it.
And PDs.
PUD reserves still have that same 90% certainty of being there, but they need significant future capital investment to get them.
Like drilling a whole new set of wells.
Or building a new pipeline to a remote part of the field. That's a PUD. It's proven, but it's not monetized yet.
And the SEC is really strict that you have to have a firm budgeted plan to develop those PUDs, otherwise you can't even call them that.
That budget commitment is absolutely non-negotiable.
And then finally, the accounting. We mentioned booking reserves, but what happens when you start pumping the oil?
The asset depletes. Every single barrel you bring to the surface and sell is removed from your reserve estimate. This constant, rigorous recalculation of what's left is essential for tracking a company's financial health.
Okay, so we've got reserves locked down, they're discovered, commercial, high certainty. But that's just one piece of the puzzle. There's this massive landscape of potential oil and gas that PRMS calls the resource spectrum.
Right. These non-reserve resources are, by definition, anything that hasn't met those strict criteria for reserves. They haven't been produced, and they often lack the commercial viability, at least for today.
So what's the first step down that ladder from reserves?
That would be contingent resources. You'll see them called 1C, 2C, and 3C.
So what's the contingency? What's stopping them from being reserves?
The key is that a discovery has been made. Hydrocarbons are there. You've found them. But the project is stalled. Commercial development is contingent on something changing.
Okay, like what? What are the common roadblocks?
They're all over the place. It could be economic. The current oil price is just too low to make a profit. Or the cost to build the infrastructure is too high.
So you're waiting for the market to improve.
Or for a new technology to emerge that lowers your costs. Then you have regulatory contingencies. Maybe you're waiting on environmental permits or trying to negotiate fiscal terms with the government. Until you solve that specific problem, it stays a contingent resource.
And unlike reserves, these introduce a whole new layer of risk, right? The chance of success.
Yes, COS, or possibility of success, POS. This is a critical difference. With reserves, you're mostly worried about volume uncertainty, the range from P90 to P10.
How much is there?
Exactly. With contingent resources, you have that, but you also have to assess the project risk. What's the likelihood that the roadblock, the contingency, will actually be resolved so the project can even go forward?
So you could have a huge volume of oil that you're very certain about. But if the political situation is unstable, the chance of success could be tiny.
And that makes it a much riskier asset than a smaller 1P reserve in a stable country. It's a separate calculation.
That makes perfect sense.
Yeah.
Okay, let's go even further down the spectrum to the most speculative part of the business, prospective resources.
This is the frontier. These are, by definition, undiscovered accumulations.
Undiscovered.
Undiscovered. They're the prospects and leads that geoscientists identify on seismic maps. They're the targets for exploration drilling. Nothing has been confirmed by a drill bit yet.
So the uncertainty must be enormous.
Absolutely massive. The volume uncertainty is huge. You'll see it as 1U, 2U, and 3U for low, best, and high estimates. Your 1U might be 50 million barrels, and your 3U could be 500 million.
A tenfold difference.
Easily. And on top of that, they carry the highest possible geological risk. The chance there's nothing there at all, that the trap is empty. That risk could be 80, 90%.
So how can companies even talk about these numbers publicly?
This is where the SEC puts its foot down the hardest. Generally, the SEC does not allow public reporting of undiscovered resources. They are just too speculative.
But companies do talk about them.
They do internally and maybe in high-level investor presentations to show they have a future, but those 1U, 2U, 3U numbers are almost always for internal planning. It's all about managing expectations.
Okay, so we've got the categories down, but the billion-dollar question is, how are these volumes actually calculated, especially when you're talking about something thousands of feet under the ocean floor?
Right. This gets us into the methodologies, and I have to stress one point again. The total amount of oil in the ground, what we call CDOI-IP or DIP, that number is commercially irrelevant.
The only thing that matters is what you can get out, the recoverable part.
That's the only number that matters, and that's all governed by one metric, the recovery factor, or RF.
Which is the percentage of the total oil you can actually produce.
Exactly. It's the ratio between what's in place and what's recoverable. If you have 1 billion barrels in place, but your RF is only 20%, you have a 200 million barrel field. It's controlled by geology, rock quality, and the technology you use to get it out.
A good conventional field might have an RF of what?
Maybe 40 to 60%. A really poor one might be 10%. It makes all the difference.
Okay, so let's start with the technique for the highest uncertainty stuff. The analog, or yet-to-find, YTF method.
YTF is basically geological comparison. You use it for prospective resources where you have almost no data.
So you find a similar-looking place that's already producing oil.
You got it. You find a producing field somewhere else in the world that looks geologically analogous. Same type of rock, same type of trap, and you just substitute its known performance data.
The argument is, if it works there, it should work here.
That's the argument. It lets you generate potential volume estimates for entire regions that haven't been drilled, but it is incredibly high risk. A tiny geological difference can make the analogy completely worthless.
Okay, moving on to something more rigorous. The workhorse of early estimates.
Uh-huh.
The volumetric or static method.
Right. This is where you move beyond just analogy and start using real data, like seismic maps, to define the size and shape of your container.
And there's a core equation here, isn't there?
There is. It looks a little intimidating, but it's fundamental. It's recoverable volume equals gross rock volume times net to gross times porosity times hydrocarbon saturation times the recovery factor.
Wow.
All divided by the formation volume factor.
Okay, let's break that down because a little uncertainty in any one of those things could throw the final number way off. What's gross rock volume?
Gross rock volume, GRV, is just the total geometric volume of the trap, the size of the box, which you measure from seismic data.
And net to gross.
That discounts all the non-reservoir rock inside that box, the layers of shale or cement that can't hold any oil. It leaves you with just the productive rock.
Then porosity is how much empty space is in that rock.
The percentage of the rock that's pore space, where the oil and gas actually live, and that can vary hugely depending on the rock type.
Right. And then you need to know how much of that pore space is actually filled with oil versus, say, water.
That's hydrocarbon saturation.
We've covered RF, the recovery percentage. The last one, the formation volume factor, FVF, seems a bit abstract.
It's critical for the money side. Oil and gas are under immense pressure and heat down in the reservoir. When you bring them to the surface, the oil shrinks and gas expands.
So a barrel down there isn't a barrel up here.
Exactly. The FVF is the conversion factor that turns a reservoir barrel into a stock tank barrel, the kind you can actually sell. A miscalculation here can dramatically skew your final number.
And these volumetric calculations, they can be done in two ways, right?
Correct. For early, uncertain prospects, we use a probabilistic method. We put ranges and distributions on all those inputs and run thousands of simulations. For later, more certain reserves, we might use a deterministic method, where we just pick one conservative P90 value for each input to get a single 1P estimate.
Okay, but now the well is drilled, it's flowing, the data gets real. We move from these static pictures to the performance-based or dynamic methods.
Right. These methods use actual real-time production data rates, pressures, volumes. This gives you the highest possible confidence because you're constantly refining your predictions based on reality.
And the most sophisticated of these is reservoir simulation.
That's the big one. You build these massive 3D computer models of the reservoir broken into millions of little grid blocks, and you try to predict how the fluids will flow over decades.
And the key is making the model match what's really happening.
That's the challenge. It's called history matching. You tweak all the properties in your model, the permeability, the faults, until your computer simulation perfectly matches the actual daily production history from the well.
That sounds less like a calculation and more like detective work.
That is a perfect analogy. It's the most rigorous method, but it's incredibly resource intensive. But as you get more production history, your predictions for what's left become more and more accurate.
Then there's the materials balance method. That sounds a bit simpler.
It's based on a fundamental law of physics conservation of mass. It uses an equation that relates the volumes you've produced to the measured drop in the reservoir's pressure.
So the pressure drop tells you how much is left.
In simple terms, yes. It's very accurate for conventional fields, but you need good pressure data, and you typically need to have produced about 5 or 10% of the field before it becomes reliable.
And the last one is the most intuitive. Production decline curve analysis.
The decline curve. This is basically just extrapolating a trend. You take the production history of a well, you see how its output is declining over time, and you fit a mathematical curve to it.
And project that curve into the future.
You project it forward until the well is no longer economic to operate, and that gives you your estimate of remaining reserves.
But it seems like that would be really sensitive to, operational hiccups. A well shuts down for a month, that messes up your trend.
That's its biggest weakness. It assumes the future will look just like the past, which isn't always true. You have to be very careful to filter out any artificial noise to get a good extrapolation.
Okay. We've laid out the whole framework for conventional reservoirs, but so much of the conversation today is about unconventional reservoirs. Shale gas, tight oil. How do they fit in?
That's a vital question because the PRMS and all those techniques we just discussed, they rely on the physics of conventional reservoirs. Where oil and gas flow because of buoyancy, they want to move.
But in unconventional rock, they don't.
They're trapped. They're tightly bound in extremely low permeability rock. Capillary forces hold them in place. The traditional flow models they don't work.
So the viability isn't about the rock, it's about the technology you use to break the rock.
It's almost entirely about the technology. Hydraulic fracturing, horizontal drilling. You have to create the pathways for the fluids to escape. Quantifying that is incredibly difficult.
So how do companies book PUD and 1P reserves in a shale play?
It relies very heavily on two things: extrapolation from a few good wells and analogs. You take the performance of a handful of type wells, and you basically apply that performance across thousands of acres.
That sounds really speculative.
It is. To get proven reserve status, companies often have to run dedicated pilot projects to prove their fracturing technique can be repeated economically over and over again. It's a much higher bar to clear.
And this uncertainty, combined with the huge value of these assets, this leads us into the politics of it all.
Yeah.
The politics of quantification. These numbers are not always objective, are they?
Not always. Let's start with a known industry phenomenon: reserve growth. It's the fact that initial estimates for new fields are almost always too low.
So the estimates always go up over time. Why?
It's mainly driven by technology and data. As a field gets older, you understand it better, your models improve, and you find new ways to get more oil out enhanced recovery techniques that weren't in the original plan.
So the recovery factor just keeps improving.
It does. A field that started with a 25% recovery factor might end up at 35% 2 decades later. That growth is natural, and it leads to constant upward revisions of 1P and 2P reserves.
But then there's the darker side, manipulation.
Right, especially when you're dealing with national oil companies or governments that aren't subject to SEC oversight.
They don't have to show their work.
Many of them don't. They don't release the raw seismic data, the pressure histories, the well logs that you would need to independently verify their reserve claims.
And without that verification, the numbers can become, political tools.
Precisely. We've seen cases where a country's reserves jump dramatically overnight with no new discovery to explain it. Those numbers can be used to get better loans or gain more influence in OPEC or just for domestic political reasons.
And finally, there's this huge political issue that has emerged recently, one that seems to be on a collision course with the technical reality of reserve growth.
You're talking about the 2021 statement from the International Energy Agency, the IEA.
I am. They said that to meet climate goals, countries should stop investing in projects to expand oil and gas reserves. No more exploration.
It's a direct command to freeze the reserve base.
But if, as we just established, the natural engineering-driven trend of every field is reserve growth, that estimates will always increase over time. How can those two things coexist?
That is the central conflict. A political mandate is crashing into a geological and engineering inevitability. The mandate says stop investing in PUD projects because those projects increase reserves.
But not developing your PUDs means leaving financially viable oil in the ground, which goes against a company's duty to its shareholders.
It's an incredible tension. What does no new investment even mean when new technology inherently makes your existing fields more productive and grow their reserves?
It seems like the political argument is fighting against the observed physics of how these reservoirs actually perform over time.
It is. And the industry is right in the middle of that conflict, trying to figure out how to reconcile those two opposing forces.
So what does this all mean for you, the listener? We've done a deep dive into this language of subsurface value. We've learned these aren't just fixed numbers, they are ranges of uncertainty.
Understanding reserves means understanding the certainty of 1P, that 90% confidence floor, and the statistical expectation of 2P, the 50% most likely number.
And seeing that clear, bright line between what's commercially viable today, the reserves, and what is still speculative, the resources.
And we've walked through how those numbers are built, from the high-risk analog method to the foundational volumetric equations, and finally to the high-confidence performance-based methods that use real data.
It's a system built to manage risk, but it's always in flux, always changing with geology, technology, and market prices. Which leaves us with a final provocative thought for you to consider.
Go on.
If a company strictly follows the SEC's conservative rules and only reports its 1P proven reserves, but it knows from decades of engineering history that today's optimistic P10 possible reserves often become tomorrow's P50 probable reserves, is our current financial system, by design, structured to systematically underestimate the true ultimate longevity of the global energy supply? And if it is, what does that imply about the transition timelines we're all debating?
It really forces you to ask if the conservative language of finance can ever truly capture the long-term optimism of technology. It's a fundamental disconnect.
A fascinating conflict to ponder. Thank you for joining us on the deep dive. We hope you feel a lot more informed about the complex language behind the world's most valuable commodities. We'll see you next time.